If you've been diligently saving up over the last little while to purchase your very first home and you're looking for a new tool that might help you get there quicker, well, this video might be the video for you. My name is Joey Virgilio, realtor with Sage Real Estate and a part of the Toronto Livings team. If you end up finding this video helpful or learned anything along the way, it would mean a lot if you can hit the like button and subscribe to our channel. So as of April 1st, the government of Canada has actually released a new tax sheltered account that can be utilized for first-time home purchasers in order to save up for their first down payment a little bit faster. This account is known as the FHSA, which stands for the First Time Home Savings Account. So what exactly is the FHSA? So you may have heard of the RRSP or the TFSA. And the best way I can describe the FHSA is that it almost takes the best benefits of the TFSA and the RRSP and kind of combines it into one. So the RRSP was created by the government in order to help Canadians save for their retirement. And the TFSA was actually created as used for general savings. But the FHSA was specifically created to help you purchase your first home. Let's start with the contribution room. Now, the lifetime contribution you can add to this account is $40,000, meaning that's the most amount of money that you'll be able to put into this account. Now, if you were to open this account tomorrow and you have $40,000 saved up, you can't just open it and drop the entire $40,000 into the account. They have a limit of $8,000 per year, which you'll be able to put in until you reach the $40,000 maximum. So why is this and how does this work? Or at least in practice, how does this work? There's going to be three main benefits I go over in this video that kind of covers the core of why this is such a helpful tool for Canadians. The first is it is income tax deductible. So just like the RRSP, if you were to open the account tomorrow and deposit the full $8,000, which is the max you can do in the first year, then for simple math, let's just say you're somebody who makes $68,000 per year. Well, that year you'd be able to deduct your income and claim as if you've only made $60,000 for the year. That being said, come tax time, you're either going to be taxed $8,000 less than you would have, or if you get a tax return, that return is only going to be so much bigger, in which case you can take that excess and roll it back into the account if you want to. The second benefit I'm going to go over is that it is tax-free for your investments. So just like the TFSA, if you were to take that $8,000 that you just put in and use that money to buy stocks, bonds, GICs, anything that accumulates interest over time, well, that money that you've made on top of that $8,000 is now also tax-free. So it remains tax sheltered. It doesn't have to get claimed as income tax or capital gains tax. As another added benefit to this feature, if you were to say take that $8,000, you had invested it, and you've made back, let's say, another $1,000 on top, well, that $1,000 that you've now made extra, it also doesn't affect your contribution room. So you can still keep adding that $8,000 a year until you've maxed out that $40,000. Lastly, benefit number 3, if you use this money to purchase your first home, you will not be taxed on it, nor will you have to pay it back. So for instance, this idea has actually already existed with your RRSP. But the difference with the RRSP and the FHSA is that because the RRSP was initially supposed to be a retirement savings plan, once you've used that money to purchase your first home from an RRSP account, after 2 years, you actually have to start paying yourself back over a 15-year span. But with the FHSA, this isn't a thing. You can just use that money as your down payment and move forward. So who can open up this account? So there are a couple restrictions. So the main ones are you have to be a Canadian citizen, you have to be 18 years or older. This has to be the first home that you're purchasing, or it has to be over 4 years since you've owned your last home. And lastly, it needs to be your primary residence. So you can't use your first purchase as an investment property and still take advantage of this account. So there's a lot more little details when it comes to the FHSA that I didn't go through in this video, but I figured this might be a good way to kind of just showcase the main points and the main benefits that this account does bring. So is it going to be a gigantic game changer? Only time will tell, but you can treat this as a really useful tool that the government of Canada has given to first-time purchasers. And I would treat this as a big benefit that we didn't have in the past. If you'd like to discuss in more detail, feel free to reach out or leave a comment. Otherwise, you can find more from myself on the Toronto Livings Real Estate podcast with my co-host and fellow realtor, Mark Savell. Once again, if you found anything of value in this video, it would mean a lot if you could like and subscribe. Otherwise, we'll see you next time.